Now we turn to the refined products, and we just want to reiterate, please like, share, subscribe. Your support is appreciated. So here's where we always look at, and this is focusing on gasoline, jet fuel, distillate, and residual. So we want to look at, what are some of the key drivers, not looking at NGLs and that side. So currently we have, demand is 15.362 million versus last week's of 15.5. So you're seeing, again, we're just not getting back to those normal levels, just shy of that by about, 1 million barrels a day. And when you look at just the average coming in at about 15.08, you're seeing that we're sitting right at that 15 million. And this is what we've been talking about, where gasoline will go up and down, distillate will go up and down, but it's netting out to be less than normal when we go through, and that's where we expect to be as we head into the winter months and the fall months. As you can see, typically by the time you get to the end of August, beginning of September, you start to see that slowdown, and we expect to see something very similar along those lines and a bit more of a bit faster. And we'll talk about that in the econ show, just because you're starting to see some of those adjustments in general. But again, this is seen this very gradual pace. And the solid number is, again, that average, where when you look at the lighter line, you can see kind of how much it can move. And that's why we try to look at things holistically when we're talking about the different demand cycles. So then when we look at distillate had a build of 830,000 barrels. The pad 1 had a big build of 2.1. That was really what drove the build in general. Then when you look at imports still remained elevated, even though they walked back a small amount. And then when we look at yield, the shift has started already when you look at gasoline versus distillate yield. So gasoline yield still is high for this time of year. I'm not saying it isn't. It was at 63.3% last week. Now it's down to about 62%. It's typically at about 59 to 60%. So you can still see refiners are still targeting the gasoline cut more, but are starting to walk back a bit. And that you saw an increase in distillate from about 30% to about 30.6%. So you're starting to see that pivot from one to the other. That will accelerate as we get into the end of August. We'll probably stay at about this split through, let's call it, the next 2 weeks, and then you'll start to see that movement over. And this is one of the reasons why, when you look at that distillate, it's still a build, it's still moving in a general trend, but there's still opportunity to get some additional capacity out there, just because that's where we have the most storage available. And that's something that we think is going to continue, especially when you factor in the diesel demand still remains robust. That's still where we see the lion's share of demand, especially as we go through peak shipping periods for the holiday season, because now is when you start to plan for Black Friday and the Christmas push. So then when we look at the demand cycle, we were expecting the demand to fall back to the 5-year average. Instead, it went from one extreme to the other. Again, still averaging out something in the middle. That's something that we think is going to continue as it bounces back up. One of the things that we're starting to see is a little bit less demand in trucking, and it's less because there's no demand for trucking, because when you look at load availability, it's up. It's just pricing. People are starting to get a bit more sensitive to pricing. We had another tick up in gasoline and diesel prices. So you're starting to see some balking and some utilizing rail to a much greater extent. There's also obviously been significant issues at the port, but load availability is not the issue. It's just, what are people willing to pay? And you're starting to see a little bit of a slowdown in rates, but it's not, again, it's just a matter of who's the truck driver and how much hiring. When you look at some of the things that have been happening, we are now looking to import truck drivers because we're so short. And that's going to be something to watch, as to see how much of this new capacity is going to be coming in, because there still remains a lot of demand. But where you're not seeing trucking demand, we are seeing more rail demand. So when we look across the board, motor vehicles and parts continue to be a problem. There's still supply chain issues up and down. We're going to cover the chips and the tech sector again in segment 1. of the econ show, but here you can see that remaining elevated. Intermodal units still middle to upper single digits, double digits. That's going to keep us, well over, well placed at that 16% versus 2020 on a year-to-date level. Then when we look at metallics, ores, metals, coal is moving at a faster clip. That's going to continue. Grains, forest products, again, all of that will remain strong. Petroleum and petroleum products is the one that we still think is going to see some fairly steady moves, especially because of the issues that we continue to see with trucking. If you can try to use that rail side. So again, these are things that are going to continue to be placed within the system as problems at the port continue to increase. As you can see, change versus previous year, change versus previous week, they all continue to go up because the ports are continuing to take new shipments. And just based on the current rate, you're going to have to see them essentially operate at record pace in order to take down all of this capacity as we head into the end of the year. From the weather perspective, we're starting to get a little bit of a pivot. When you look at the Northeast, we had a nice cooler backdrop, and that is about to change. We're about to get a nice little heat wave coming through. This will do a lot for natural gas demand. You're going to see more AC usage. This is going to shift a bit. When you look at the North and the West, they're starting to get a little bit of a break as a lot of that pivots into the Northeast. So then you look at just the maroon colors hitting over the Northeast, so it's going to get a bit toasty over the coming few days. So then when we look at gasoline, this is showing just that draw of 5.29 million. Bring us 8.4 million below the 5-year average. You had the draw was really driven by pad 1 and pad 2 when you had some small builds in 4 and 5. So here's where it's going to come down to the pivots in imports. So now pad 1 is just 4.6 million below the 5-year average. Then you look at blending components. Blending components had a draw of 4.98 million, bringing us 2.3 million below the 5-year. But you're still seeing that disconnect. And again, that's speaking more to the issue with the blenders, where you're just, when you look at what is actually moved from the blender week over week, it was actually fairly small. So that's where we expect to see that makeup in the implied implied demand, just based on that supply movement. And then as we look at imports, as we've been saying, we expected to move it closer to about 860,000 barrels a day. Came in at 844, so we were close. Down 65,000 barrels, 67,000 below the 5-year average. We expect it to level off a bit. The low end is probably 760,000 barrels a day. But again, it's just going to be a matter of how much of that new product coming into the Atlantic Basin ends up coming into pad 1. And we do have more product coming from Asia into pad 5. So that's going to keep that pad 5, which you can see is 81,000 barrels a day over the 5-year average. That's going to stay elevated. Now, when we look at storage, you can see that we're right back to the low end, but this is when we're supposed to be seeing this rollover. The pace picked up versus historics, looking over the last 29 years, but we expect to see this level off. And that's what when you look at that 29-year average, you can see, or that dotted white line, we expect it to follow a similar slope as we head into the end of the year. The end of summer. Now, weekly U.S. imports of gasoline from Europe fell for the ending July 29th. Gasoline arrivals into the U.S. dropped to 292,000 barrels a day versus 377 barrels a day. So again, you're going to start to see that adjust a bit. And here's where we think that it kind of levels off. The arb closed between Europe and the U.S. So that's going to really cut down what is really coming from Europe, but we still have more of that coming in from the remainder of Asia and the Middle East into the Atlantic Basin. Weekly gasoline demand was right at those levels. When you look versus the previous week, it was about 0.6% above, coming in at a high, which again, that high brings us to about 9.6 million, 9.65 when you look at what we had from GasBuddy. But then as we look forward, according to GasBuddy data, Tuesday, U.S. gasoline demand fell 1.5% from the prior Tuesday and 0.9% below the average of the last 4 Tuesdays. And it was the lowest daily demand since July 13th. Monday was 1.6% from a week ago, and Sunday was negative 0.7% from a week ago. So Still getting kind of that movement. We expect this to go sideways. Now, this is interesting because typically Descartes is higher than EIA, but U.S. gasoline demand declined less than 1% to 9.541 million barrels a day in week ending July 30th after 2 consecutive weeks of gains. So again, you had U.S. EIA implied demand of 9.77. You had Gas Buddy at about 9.65. You had us at about 9.6. You had Descartes at 9.5. So you're kind of seeing that trend coming back down. Now, as we go forward, we're starting to see some of that slowdown. You had some of that overshoot to the upside. You'll have an overshoot to the downside, putting us closer to about 9.1, 9.2 on the U.S. EIA implied demand, which is going to counterbalance getting us back to about that 9.3 that we keep describing as what we expect to be kind of that normal pace. And here's one of those big drivers. We've done it. We're now above $3.15 on a U.S. national average. We're at 3.159, so 3.16. Again, this is when we look at inflation, when we look at pressures, when we look at things that everyone likes to talk about transitory. But when you look, so we saw Q2, and we'll go through Q2 GDP and inflation numbers. As we've been saying, they were going to be very high. And now as we go into Q3, we already had July. July was up versus June. Now we have August. So far, now August is up versus July. The trend continues. And then when we look at diesel's at $3.36, almost $3.37. And again, that's just speaking to the issues that we're seeing where people are like, well, maybe I'll wait on some of that trucking, see if some of the diesel normalizes, see if I can get a deal. But again, these are real costs that are impacting people, consumers, the way they're purchasing, the way they're going to travel. When you go to fill up and, let's just say West Coast, Pad 5, obviously picking the worst one, you're at $3.91 on average. So that means that you could easily find a place within your vicinity that's over $4. So you're going to consume differently when you see that kind of price or try to mitigate some of your driving. Now, when we're looking at blending components, we're right back into the normal. You can see we normally have that acceleration into the end of August. We expect to follow that trend, again, just kind of softening what that movement looks like into that normalizing level. Now, when we look over the last 15 years here, you can see we're back above to that high level. But again, now that's a mixture of you have a shortage of drivers, again, trying to bring drivers over. You have seasonal demand, so it's stronger than normal, and stronger than previous, and I should say previous spring because it's seasonal. And you have the shortages of truck drivers. So again, I'm sorry, but then you also have the import-export capacity. So imports have come down, exports have been fairly flat. So you get all of these moving pieces. And all of a sudden, this is why we think that you get this move up. Now you're going to come back down and come down to what we believe is that, that 15-year average. Now looking at it against the last 5 years, one of the things that we said last week was that you naturally get a bump up. So you typically come down, then you get a bounce. And we were expecting a little bit more bounce last week. When you look against 2019, when you look against 2017, 2016, you normally get this pop after these falls, then it's just going to be a little bit less, especially after July 4th. Instead, we just went sideways for 2 weeks, and then we had a move up. So again, you had these weaker numbers that should have been a bit higher. Then you have a number that's now too high. So now you're going to get this drop down, and we expect it to come back into that 9.1, 9.2 level. So then when we look at why, well, parks are rolling over a bit. You can see workplaces is still fairly flat. Everything is moving kind of in that steady state sideways. So there's really nothing that's saying that there's more coming out than previously. And then when we look at Apple data, you can see in general on the U.S. side that we're seeing some of this pretty steady movement. And remember, Apple mobility is just based on search, not actually execution. So just put that in your mind's eye when you're thinking about that. But here's where you can see Italy moving back up to the highs that it was. That's starting to roll over as we showed in segment 1. And then the same is similar with Germany, and the UK is something fairly flat. So we still think that you get this fairly flattish move through August and then start to roll over into September as usual. Propane had a build of about 1.46 million, came in at still 10.3 million below the 5-year average. Still, as we've been saying, it's just going to track 17 and 18. Demand still remains elevated when we look at where things sit right now. Pricing is still strong, still over $1 at $1.08. You have some capacity in Korea coming back on, and that's going to increase the movement of naphtha. But again, you're still seeing a lot of that demand for propane and LPG, which will continue on the export side, which we'll talk about in segment 3. The pace of COVID vaccinations, slowing down a bit, but again, you're slowing down from a higher base, so you normally see that move. India is the one that's a bit concerning because you're not seeing the huge step up that you'd like to see. And then when you look at around the world, especially in Asia, you're still seeing some of that struggle to get some of that momentum, even though the world has picked up, but the U.S. continues to slow. Now, when we look at that share of people that are vaccinated, one of the concerning things, and this is, this should change as people get, let's just say, spooked a bit in terms of some of the increases in the U.S., but the U.S. is sitting at about 49%, and that's a no change from week over week. But the share of individuals with one vaccine has increased slightly. So again, that's going to, once you get to the second one, that'll bleed down. But you can see the slowing pace, and a lot of individuals still remain, I don't want to get it, won't get it. So again, we're starting to get towards the end of that movement. And then you can see that it's continuing as India, you saw a big pickup in first, but again, that second shot still remains a bigger problem. So now when we move to jet fuel, we were expecting to see a bit of a drop. Instead, we went sideways. You had a draw of 1.76 million. That's something that's going to be managed because you're still 2.6 million over the 5-year average. So that's where we're going to play with distillate cut, kerosene cut, and then the jet fuel side will come back a bit. But again, it's just going to be working within a fairly tight range as we've been talking about. The bigger issue here is when we look at the North America and the Americas, you're starting to see flights roll over. This is congruent with what normally happens in August, so we're not seeing anything crazy. Europe is catching up, where when we look at the rest of the world in Asia Pacific, they're starting to roll over again. So the average number of departures per day remained fairly flat week on week. Year-on-year average departures were up. Departures in Europe and India led growth, while departures in the U.S. led decline. So again, you're starting to see that adjustment lower. And as you get less departures, even if you get TSA passengers remaining stable, less departures means less jet fuel because you have less planes leaving, even if passengers stay the same. Now, as we look forward, the passenger flight schedule for the 11 weeks ahead declined by around 1.8% since last week. APAC cut 6.1% of flights across the next 4 weeks as Australia, Indonesia, China, Malaysia, Singapore, and Japan implemented further restrictions. And again, you're just seeing that's another about 100,000 barrels a day of demand gone just like that. And again, these are the things that we continue to see and talk about. And this is what is going to weigh on some of that movements as we get into the end of the year. Now, when we look at TSA passengers, you can see that we actually had a fairly big drop. And when you look against 2019, it's normal. And that's what I've been trying to explain. And I'll say it again. Look at the departures. Departures of flights are dropping. So now that this just means that when you look at TSA passengers, we expect to see a lower high and lower lows, not because it has nothing to do with COVID at that point. It's just seasonal. We're seeing a normal seasonal drop where you look at 2019, you see how it starts to go down. It's not gradual. It's not a huge collapse. You get one more spike for Labor Day. We're going to see something very similar. And that's where we continue to say we're at this level where we're going to have a slightly lower high, slightly lower low, and that's going to move in the direction with 2019. So then when we look at restaurants, open table, again, plus 5% on the weekends, minus 10% weekdays. Again, that's the shift that we continue to talk about. More activity on the weekends, less activity on the weekdays, continuing to be just below what is normal given the headwinds that we see across the board. So now that we've gone through the U.S. in a bit more detail, we're going to pivot and look abroad and talk about some recent developments and then factor in how the U.S. plays within that on a go-forward level.